Welcome to this elite explainer for IGCSE Accounting 0452. I'll be your subject specialist today, guiding you through the correction of errors via journal, but I'm also putting on my senior examiner hat to give you the ultimate insider perspective. We're going to elevate your understanding way beyond basic ledger entries, showing you exactly how to think, calculate, and analyze like a top-tier A-star candidate.
Now look, stop thinking of the journal as just some boring chore. You aren't just a data entry clerk ticking off boxes here. You are literally building the architectural foundation of financial reporting. Every single correction is a vital bridge connecting raw data to high-level global business intelligence. It's a real game changer when you shift that mindset.
Here's our game plan for today. We're covering the A-star conceptual foundation, advanced technical execution, AO3 interpretation and ratios, and finally, those critical examiner pitfalls.
All right, let's dive right into Section 1, the A-star conceptual foundation.
So, looking ahead at the syllabus 2028 to 2030 updates, Cambridge is getting incredibly strict. They mandate modern international terminology. That means you absolutely must use irrecoverable debts instead of bad debts, and owner's equity needs to be used with 100% accuracy. Honestly, using outdated terms just signals to us examiners that you aren't up to speed, and we are actively scanning for this updated vocabulary to award those top marks.
And this brings us to the accounting equation. This duality is your ultimate anchor. Assets must equal liabilities plus equity at all times. When you correct a journal error, you are actively repairing a fracture in this equation. It's literally the lifeblood of the business entity concept.
Here's a big one. Ignoring potential losses just to overstate your profits isn't just a tiny whoopsie. It is a direct violation of the prudence and historical cost concepts. When the numbers try to lie to you, you have to use specific vocabulary, words like accrued, prepaid, and realization, to force the truth and maintain total transparency.
Now, why does all this rigorous accuracy even matter? Well, think about who relies on these records. Banks, owners, and tax authorities rely entirely on the integrity of your corrections for their major decision-making. Sure, in modern industry applications, AI-driven accounting systems like Xero automate the basics, but your human ability to ensure conceptual integrity and correct complex system errors, that remains your ultimate irreplaceable asset.
Moving right along to Section 2, advanced technical execution.
If you're working on practical coursework, this procedural flow is your absolute holy grail. You need to document your evidence chronologically. Start with the source document, like an invoice. Trace it to the prime entry, balance the trial balance, and then finalize the statements. If an error pops up, you have to investigate exactly where that chain broke.
Okay, I want you to lean in for this one, because here is a massive examiner secret for securing that A-star, the method mark strategy. We will actually award you marks even if your final calculated balance is totally wrong, as long as your logical flow is clearly visible on the page. For complex multi-step adjustments like depreciation or inventory valuation, you've got to show every single step of your workings.
When you're tackling T accounts, mastering the difference between balance brought down and balance carried down is vital. Here's a quick memory hack for you when exam pressure hits. Carried down closes, bring down begins. Messing this up instantly destroys your trial balance accuracy. It's an unforced error we see way too often, so don't let it happen to you.
Speaking of unforced errors, watch out for common mathematical pitfalls. Mixing up how you calculate trade discounts versus cash discounts is a classic trap. And forgetting state symbols in manufacturing accounts, that strictly separates the A candidates from the true A-stars.
All right, on to Section 3, AO3, interpretation and ratios.
Imagine a scenario where a business's current ratio suddenly plummets from a healthy 2.5 to 1 down to a worrying 1.1 to 1. Calculating that drop is just your baseline AO2 skill. To secure those crucial AO3 evaluation marks, simply stating the new number isn't going to cut it. You have to investigate what this dramatic drop actually means for the business's day-to-day liquidity.
You literally have to become a financial detective. Why did the ratio fall? Did the business overpurchase inventory? Is there a slow settlement of trade payables? Or perhaps cash was depleted by a massive capital expenditure? Using your investigative skills to uncover that root cause is exactly what forces us to give you the top evaluation marks.
And when you're doing inter-firm comparisons, direct comparison is notoriously difficult because different businesses use different accounting policies. One firm might use straight-line depreciation, while a competitor uses the reducing balance method.
As an A-star candidate, you must adjust your analysis to account for these differing policies before making any kind of valid financial evaluation. But remember, the numbers absolutely do not tell the whole story. You have to analyze the true quality of a profit. When evaluating long-term return on capital employed, you've got to consider non-financial factors. Things like plummeting staff morale, a deteriorating retail location, or a damaged market reputation can completely destroy a business, even if the journal looks absolutely flawless.
Which brings us to our final part, Section 4, Critical Examiner Pitfalls.
Listen closely to this direct examiner insight. Poor, illegible handwriting in ledger accounts literally cost students their grades. Seriously, if I can't read it, I can't award the mark. Furthermore, confusing a revenue expense with a capital item is a massive conceptual flaw that will instantly derail your entire grade weightage.
So, we're going to leave you with this pause and think A-star challenge. I want you to mentally trace a single uncaught error, like treating a routine vehicle repair as a capital asset purchase. Trace it through the entire procedural flow. Watch how it artificially inflates profit and totally distorts your equity. Ask yourself right now, is your logic robust enough to catch that ripple? Thank you so much for joining this explainer, and good luck mastering the syllabus.